Every owner of taxable personal property on January 1 must file an annual personal property return, known as the Form of List or State Tax Form 2, with the Board of Assessors of the city or town in which the property is situated on that date. Cellular or mobile wireless telecommunications companies must use State Tax Form 2MT to make their return. An owner of household furnishings and effects at a residential property in Massachusetts that is not the owner's domicile, such as at a summer or second residence, must file State Form 2HF listing those furnishings and effects. Exempt charitable and veteran organizations list their exempt property, including real estate, on State Tax Form 3 ABC. The return is signed under oath. The schedules in the return that detail the taxable personal property situated in your city or town on the January 1 assessment date are confidential. They can only be disclosed to the taxpayer's designated representatives, persons who need to see the information to perform duties in the Office of the Assessors and the Department of Revenue, and anyone else specifically authorized by court order. Information that must be provided about the listed property includes the make and year of manufacture, and the purchase price or original cost and year of purchase. The owner does not have to include an estimate of current value. If an estimate is provided, it is not binding on the assessors as they determine the fair cash valuation of property for local tax purposes. Returns of taxable personal property owned by the taxpayer on January 1 must be filed with your office on or before March 1. You may extend that deadline if the taxpayer makes a written request and provides a reasonable excuse for not filing by March 1. You may grant an extension as late as the deadline for filing for abatement for the respective fiscal year. As with real estate, personal property is valued at its fair cash valuation on January 1. You will usually use the cost approach to value personal property. Depending on the property, this means the reproduction, replacement, or original cost of the property, less physical and functional depreciation and economic obsolescence. You can refer to pricing manuals to assist in determining the cost of a wide range of items. Depreciation must take into account the age, condition, and quality of the item of personal property. Property still in use has a utility value even if its life expectancy has been exceeded and it has zero value for accounting or regulatory purposes. Generally, property in use is not depreciated below 20%, although depreciation to as low as 5% might be appropriate where economic obsolescence principles apply. The valuation of some personal property is determined by the Department of Revenue and certified to the owner and local assessors. You must use these certified central valuations when assessing taxes, unless revised through the appeal process. The department centrally values pipelines that are longer than 25 miles and owned by an entity other than a gas or electric company. The owners file returns of pipeline assets with the department. The returns are due January 31, values are certified by June 15, and the owners and assessors have until July 15 to appeal the values to the Appellate Tax Board. If an entity that owns a pipeline subject to central valuation also owns other taxable personal property, it reports it in a form of list filed with your office. You value that property. The Department of Revenue also centrally values the machinery, poles, wires, underground conduits, wires and pipes owned by telephone companies and used to provide landline telephone service. Telephone companies, for purposes of central valuation, are not defined by statute, but court cases have found that mobile and cellular phone companies are not telephone companies for that purpose. Cell phone towers are taxed as real estate, but the equipment attached to them, which may be owned by entities other than the tower owner, is treated as personal property. In addition, cable and broadcast television and internet companies are not centrally valued. The assets of these non-telephone carriers are reported and valued locally. Note that a bundled carrier that offers a blend of communication services, including a substantial landline business, is centrally valued on its landline-related assets. The Department of Revenue centrally values a landline telephone company's aerial and underground network of poles, wires, underground conduits, wires, and pipes. It also values the taxable machinery the company uses to provide telephone service. The taxability of machinery valued by the department depends on whether the company is a corporation or non-corporate entity. Telephone corporations are subject to tax on electrical generating equipment on the theory that the generation of electricity constitutes manufacturing. Power generating assets are accordingly considered machinery used in manufacturing. Unincorporated entities, including partnerships and LLCs, are taxable on all machinery used in providing landline telephone service, including switching equipment and electrical generators. Telephone companies must report their centrally valued property to the department by March 1. However, any other taxable items of personal property of telephone companies not used in providing telephone service are reported on State Tax Form 2 for you to value. The department certifies values by June 15, and the companies and assessors have until July 15 to appeal the values to the Appellate Tax Board. If a company or Board of Assessors did not appeal by that date, and then receives notice the other party timely appealed, it may appeal in response. It must do so by July 30 or 15 days after receiving the notice, whichever is later. You may audit the books, papers, records, and other data of a taxpayer in order to determine whether the taxpayer has completely and accurately reported all taxable personal property. The look-back period, or the time period which an audit can cover, runs for 3 years after the form of list for a given fiscal year is due or filed, whichever date is later. So you may conduct a personal property audit for any fiscal year for which the form of list was due or filed less than 3 years ago. You begin an audit by issuing a summons to the taxpayer for production of books, papers, records, and other data. Any person or entity required to file a form of list is subject to an audit, whether or not it actually filed one for the year being audited. The summons must be served in the same manner as summonses for witnesses in criminal cases issued on behalf of the Commonwealth. Documents and other data within the scope of a personal property audit might include fixed asset listings, financial statements, federal tax returns, lease agreements of personal property at the business location, receipts for purchases of goods made during the audit period, and inventory records. You have until 3 years and 6 months after a form of list was due or filed, whichever happened later, to commit an omitted or revised assessment for property you discover was not originally or correctly reported or included in the commitment. An omitted assessment is appropriate when the personal property account was left out of the commitment entirely, while a revised assessment is used when particular items of personal property were undervalued or not included in the assessment of the audited taxpayer. The Department of Revenue has parallel authority to audit telephone and pipeline companies that are subject to central valuation. Taxpayers can contest the assessed valuation of their personal property through the same abatement process as applies in cases of real property tax. They use the same application form, and applications are due on the same date. Taxpayers who do not timely apply are not entitled to an abatement, as you do not have jurisdiction to act on their applications. There are 2 circumstances under which you may abate personal property taxes, even though the taxpayer did not timely apply. The first is a procedure to enable the collector to clear the books of uncollectible taxes. The collector makes the determination to abate the tax, and the assessors must process the abatement. Otherwise, assessors must present requests for abatement of taxes for which no timely abatement application was filed to the Commissioner of Revenue. There must be extraordinary or mitigating circumstances for the failure to file the application. It is within the sole discretion of the assessors to apply to the Department of Revenue for authority to abate under the so-called 8 of 58 procedure, the discretion of the department to authorize an abatement, and the assessors to abate if granted the authority. If a taxpayer owning taxable personal property does not file a return, you must assess the tax based on your best information and belief and cannot grant an overvaluation abatement. Similarly, if a taxpayer does not comply with your audit summons, you cannot grant an overvaluation abatement. However, if a taxpayer files a late return, you may abate the tax if, number one, the taxpayer has a reasonable excuse for the late filing, or number two, the tax exceeds 50% of the tax that would have been assessed if the return had been timely filed. The taxpayer in that case is penalized because you can only abate the amount over 150% of the amount that would have been assessed. For example, if a taxpayer who files a timely abatement application did not file a form of list or comply with audit summons and you valued property actually worth $1,000 at $2,000, you cannot grant an abatement. If the taxpayer filed the list or complied with the summons after the deadline, however, you may grant an abatement of up to $500 of value. Let's review what you have learned in this lesson. First, owners of taxable personal property on January 1 are required to file a return reporting it. The return or form of list is due March 1. Second, personal property is usually valued by using the cost approach, replacement, reproduction, or original cost less depreciation. The Department of Revenue centrally values pipelines over 25 miles and landline telephone company personal property. Assessors must use those valuations when assessing taxes, unless the valuations are revised through an appeal. Assessors may audit taxpayers to investigate possible underreporting or non-reporting of taxable personal property. Abatements of personal property taxes follow the same procedures as apply to real estate tax abatements. However, taxpayers who do not comply with form of list and audit requirements may lose or limit their abatement rights.